Tonight, we begin the bulletin with an outrage from tax experts in the country who have termed as retrogressive tax proposals contained in the Finance Bill 2024. Besides the motor vehicle circulation tax, which they claim will dent the country's motor vehicle insurance penetration, the experts also opposed to the proposal to introduce a 16% VAT on financial services, claiming that the move will return the country back to the era of mattress banking. The tax experts also challenged the government to account for the already collected taxes before burdening Kenyans with new taxes. Safin Acheng-Oma has more.
As Kenyans continue to mull over how much burden they have to bear following the punitive tax proposals contained in the Finance Bill 2024, financial experts say the proposed legislation was not only ill-timed but unrealistic. During a meeting that was convened in Nairobi to unpack the bill, tax and financial experts called on the government to find a working balance in implementing its tax strategy.
It is quite clear that there's still the feeling that people are getting taxed more than they could perhaps bear. We had investors giving their comments around how much taxes they have to bear, and that's uncertainty around the many tax changes that we see in the country. We had employers saying they're already contributing a lot for employees, especially where they're matching contributions, and that has an impact in terms of employment.
Their issues of concern include the proposal to introduce a 16% VAT on financial services, a move they say will have a detrimental impact on the country's journey to attain financial inclusion.
We are currently at 90% financial inclusion, where people moved away from the mattresses and they went and banked their money. But what you're seeing now is that with the introduction of VAT at 16%, and currently we also have excess duty, effectively it will mean for financial transactions, the tax has increased all the way cumulatively to 39%. This will make people reduce the number of transactions that they may have and also move away from using the normal channel, and people will go back to a cash economy.
According to the experts, the enhanced transparency, reduced corruption and increased efficiency in financial transactions are among the numerous benefits that the country has been reaping from being a cashless economy, advantages that they say may now be compromised.
So they need to pick one. They either maintain excess duty on its own and then they move away from VAT.
The bill also proposes to introduce a motor vehicle circulation tax payable on each motor vehicle at a rate of 2.5% of the value of the motor vehicle. The amount of tax payable will be set at 5,000 shillings minimum and a maximum of 100,000 shillings. The insurer will be responsible for collecting and remitting motor vehicle tax within 5 working days after issuing a motor vehicle insurance cover. Failure to remit the tax would attract a penalty equivalent to 50% of the uncollected tax, as well as the actual amount of unpaid tax. The experts argue that vesting the responsibility of compliance to the insurer will hamper vehicle insurance penetration in the country.
The insurance companies that are supposed to enhance compliance with this tax, so people will move away even from actually doing the right thing, that is insuring their vehicles, because now they're like, the minute I go take up my insurance cover, it may mean that now I have to actually pay the motor vehicle tax.
Despite the reservations, they have also pointed out proposals that they say bear positive outcomes.
When you look at it for the common wananchi, there are good perspective that has come, especially from the pay-as-you-earn aspect, where somebody will get relief. And also from the pension side, where somebody is getting additional relief so that they have something to take care of them when they retire.
I think also a plus for the bill is especially the proposed amendment to now give remission for spirits that have been manufactured from agricultural product. I think that gives a good alternative and therefore helps in mitigating the issue of illicit booze that we've also been having as a country.
President William Ruto had revealed plans to progressively increase Kenya's general tax rate from 14% to 22% before the end of his term, emphasizing the importance of enhancing revenue generation and reducing foreign debt.
Raising taxes and increasing taxes should also be tied to services. and people want to see what the government is doing with the taxes that are being contributed. If people see the value of their tax, they will pay tax.
Members of the public and stakeholders have until Monday next week to submit written views on the bill to the National Assembly. Safin Acheng Oma, Citizen TV.